Good afternoon, Nompumelelo. Thank you so much. We're coming to you a little bit earlier than we normally would have. Generally, we're across to you around 1:24 markets, but it's an exciting time because Naspers has released their results, and as Nompumelelo has mentioned, their headline earnings in the year to end March rising 91.2%, with revenue up more than a third. But to give us more color as to the year that was, we are joined all the way live from Hong Kong by Basil Zgodas, who is the Group Chief Financial Officer at Naspers and Prosus. Basil, thank you so much for your time this afternoon. Take me through the year that was for Naspers and Prosus, given the context of where we are with the pandemic.
Thank you for having me on the show, and hello to your viewers. Indeed, it's an incredible set of numbers. In fact, it's the strongest set of numbers we've put out in our history. Revenues and trading profits are at record levels, and we've accelerated growth right across our consumer internet portfolio. Look, our strategy to reposition the group for an increasingly online world has really proven to be the right strategy. We've worked over the past 3-4 years to build the businesses that we have, and that placed them well to benefit from the increased demand that we saw through the pandemic. Just some highlights to call out and talk more about our e-commerce business. Our revenues there grew 54% year on year. That's 21% faster than the year before. They actually grew at twice the growth of Tencent, and Tencent grew well too. They grew at 28%, but e-commerce doubled that growth. And then as a result of that growth, we have more and more businesses that are profitable. Our classified business, our core payment business, our e-tail business, our email and take-a-lot businesses are all profitable or approaching break even. And that's actually driven a substantial increase in the valuation of the e-commerce portfolio. Today, it's independently valued at $39 billion. A year ago, it was valued at $20 billion. And again, really reflecting the tremendous momentum we're seeing in online and in our businesses.
Right. Given where we are with a lot of the countries beginning their vaccination drive, some countries a little bit more ahead than others, some may think the e-commerce business was primarily probably driven by the fact that everybody was working from home, didn't want to go out, ordered in, and was learning from home. In the world where now we're moving away to hopefully the end of a pandemic, does that affect the e-commerce business in any way?
Well, firstly, we hope that we move out of the pandemic very quickly, because I think that's going to benefit the broader economy. It's going to benefit many more companies. So we're doing all that we can to keep our people and our customers safe, and we look forward to that day. Our businesses are going to continue to do well for a couple of reasons. First of all, there's been a fundamental shift in behavior through the pandemic. A lot more people who previously didn't use these products and services are now using them, and they've discovered the convenience, they've discovered the trust that comes with it, and we're going to continue to see those trends ahead. More importantly, we're actually in. But we've now got good data, and in markets like India, we've already started offering the access to credit and building a sizable credit business. In food delivery, currently we offer your takeout food, but we can use the same technology, the same infrastructure to bring even more convenience to you, whether it's groceries, whether it's the daily essentials that you need. We can bring it to you fast, quickly, and effectively. And in classifieds, where previously you had to go and meet, the buyer and seller had to go and meet offline to do the transaction, today, you can do the transaction on our platform. We'll take care of product vetting, of shipping, of payments. So we see lots more innovation coming. And importantly, we've now also created a fourth segment, which is the EdTech segment. We've been investing in EdTech for about 5 years, and we've learned a lot in that journey. And we now have a great set of assets, and we're well positioned in a segment that's going to explode. It's going to grow incredibly fast, driven by tech innovation and new products and services that are going to come out. And our businesses are well placed to deliver that to consumers. So we remain excited about the long-term future, and we believe we can continue to deliver very strong growth for many years to come.
Basil, it would be remiss of me if I didn't ask you this particular question. Over the past few weeks, Naspers has been in the news regarding the share swap, news that have played out. From your perspective and the people you're talking to, the investors, the team within the company, are there concerns that this could be some kind of short-term solution to what you're trying to achieve, and there may be a need to come back to the table and come back with another way in order to reduce that discount? Or are you confident that this is the structure that you've chosen right now is the way to go?
Thanks. A couple of points. First of all, the situation that we have today is created by our excellent performance, right? These numbers drive our market cap up a lot. In fact, they drive it up by more than the other companies on the JSE. If you look at the JSE, excluding Naspers over the last 5 years, the net performance is minus 11%. Once you add Naspers, we then get into positive territory, plus 16%. So that's basically a 27% differential. Now, the problem we have is quite simple. Today, if you have 100 Rand and you want to invest it in the JSE, and you say, I want to invest it across the average of the stocks, we should get 25 Rand of that 100. In fact, I could make the argument that we should get more than 25 Rand because we outperform the broader market. But we don't get 25 Rand, we get 10 Rand. And why is that? It's because funds can't own more than 10 to 12% of a particular stock. This move is going to change that dynamic. So today we only get 10 out of the 25 Rand. Once we complete this move, we will get 10 out of the 13 Rand. So that's a 60% improvement in that dynamic, and it will certainly help with the discount. It is, however, not the only thing. We need to continue to take additional steps, and the board and management are committed to that. Firstly, we need to continue to deliver results like we've delivered today. And we have the ambition and the conviction to do so. Secondly, once we get through this move, we then need to think about other things that we can do to further create value for our shareholders. So the feedback and the input we're getting is very helpful and will help us in the next step of the journey.
On that note of creating value for shareholders, what ticks the box for you and the team when you're looking for new exciting opportunities in different parts of the world?
First of all, it needs to be a very large opportunity. It needs to be something that many consumers are going to use and want to use. Secondly, it needs to be helpful to consumers. Thirdly, it needs to be local. It needs to be business. It needs to be an opportunity that can have very local elements to it. Because at the core of our model is backing local companies with local entrepreneurs and giving them the ability to build wonderful businesses, whether it's in South Africa or India or China or Central and Eastern Europe. That's what we do. So overall, we're looking to sizable opportunities that will be created by tech enablement and that will be much used and appreciated by consumers.
Right, Basil, thank you so much for your time. That is Basil Sgourdos, who is the Group Chief Financial Officer of Naspers and Prosus, letting us in on how they make the decisions and what ticks the box off for them. We're going to take a quick break and we'll have more news after this.